This is determining if your friend is living paycheck to paycheck or they actually have a career and financial plan. Every dollar the company makes in sales, how much does it get to keep? That's really the story of profitability. Context is king. A good ratio depends entirely on the industry. Hey everyone, I'm Devon Coombs, CPA, MBA. I'm ex-Google, ex-Deloitte. I teach at San Jose State and also at Ohlone College and other colleges in the Bay Area. And I'm also a fractional CFO, CAO, and advisor for top tech companies. Today, I'm going to be talking to you about financial statement analysis. This is from my college courses, but I really wanted it to be available for anyone who's interested in this topic. So we're going to get into some pretty tough material, some pretty dry analysis. So I'm going to really try to layer in my personal examples, some questions to make it applicable and give you what you would really need if you're studying for a CPA, CFA exam, or for a corporate financial analysis class. But I'm hoping it'll be a lot more fun than that, a lot more engaging, and a lot more summarized. So let's get started. This course is about making smart financial decisions for your life, for your businesses, and your career. All the tools you learn in this can make you great at personal finance. So I really want to tie in that personal finance element. And really, the most important thing about learning is more about curiosity and practicality rather than memorization. You're going to have to memorize some of these formulas for your CPA or CFA exams in the future. But in reality, most of us in our professions can just go back and look them up. So I really want to teach you why these ratios are valuable, why you need to know them, and how you can apply them to your personal and business and career circumstances. In order for us to do any financial statement analysis, you first have to understand the financial statement. So this is just a refresher. If you want more details, you go back to my Accounting 101 courses or Finance 101. But we have to remember the financial statements at a glance, and we have to understand the financial statement flow. So we always start off with our income statement. Remember, this is also known as the profit or loss statement. You're ultimately going to be figuring out your revenue, your top line minus your cost of goods sold equals your gross profit less expenses equals your net income. And then you could figure out your after-tax net income. Then that all should flow into your equity. Your statement of equity is going to tell you how many shares you have in a company, how the equity structure is formatted, common shares versus preferred shares, versus any other equity kind of arrangements. Then your income is going to flow into your retained earnings or cumulative loss line. That ultimately helps you prepare your balance sheet. The important thing to remember there is your assets equal liabilities plus equity. You don't really have to know debits and credits too much in this class. And that on your balance sheet, that's where you're going to find those specific accounts when you're doing ratio analysis. And then you have your cash flow statement. Key takeaways there are you have cash inflows and cash outflows related to operating activities, financing activities, and investing activities. And the reason we need to know these statements is we need to know where we can find our information and how these statements will ultimately be compared against a company internally. So you can compare period over period, like quarter over quarter, year over year to see how a company is trending. Or you can compare companies to each other. So you can compare a Google to a Microsoft in order to compare profitability, in order to see if one company is better priced, if one company is more solvent, more liquid, or one company is more profitable. And so the benefits of financial statements is that they're prepared in accordance with GAAP or IFRS, generally accepted accounting principles or international standards. And that allows for consistency and comparability of financial reporting and financial analysis across companies. You have to remember the accounting equation for this class. If you don't know it, please go refresh it. And you have to know what an asset is, a liability, and equity. And that's really what flows your balance sheet. And that's flowed from your income statement, the preparation of equity. And then your cash flow statement is just remember the cash inflows and outflows of operating, investing, and financing. So now we're going to go into the meat and potatoes of the financial statement analysis, financial statement ratios. And we're first going to start with just covering what kind of ratios exist and why they exist. So when we're using ratios, we really want to understand a quick snapshot of a company. We want to know if the company is liquid. So liquidity means that the company is going to meet its short-term debts and obligations. It'll exist for the next 12 months. This is determining if your friend is living paycheck to paycheck or they actually have a career and financial plan that will help them have some emergency funds so they can survive over the next 6 months or a year. Same thing with business. Then we talk about leverage and solvency. Well, maybe a company is liquid. Maybe they're able to survive for the next 12 months, but can they survive past that 12 months based on their current debt? And are they leveraging debt in a good way? Like, are they having enough debt to help themselves grow, but not having too much interest expense? Profitability is, again, an income statement assessment. So profitability is going to be determining how beneficial or how effective a company is at extracting profit, so net cash receipts, that they're going to retain against their overall revenue. So you can think of this as quality of earnings or quality of revenue analysis. And then efficiency, we're going to discuss concepts of, well, how effective is a company at converting accounts receivable and inventory into cash? So at the point of buying inventory, how quickly do they sell it, then get receivables for it, and then convert those receivables into cash? And then lastly will be market value. So how can you determine if Google versus Microsoft, which company is a better buy at current market rates? And we're going to look at concepts like price earning ratios to figure out, based off of how a company is doing, if they're priced more effectively, if they're comparable to another company, in order to make an investment decision. And also a concept called PEG. So price earnings growth ratio. And so big takeaway here is all financial statement ratios are just tools to help you make investment decisions. So you can make decisions in your own life to help run your business, to run your personal finances, or to buy stocks or shares or companies based off these ratios. Or if you're in a company, you can use this to help make investment decisions on closing deals, on acquiring other companies, on managing cash flow. So all of these are going to be helpful and are just useful critical thinking tools in order to ensure that you are applying best practices to the companies or businesses that you will be representing in the future. So big takeaway here is context is king. A good ratio depends entirely on the industry. An example here is Amazon might have a very low gross margin for its physical goods service. Amazon might have a really low gross margin for its physical goods services, but they rely on volume. While Google, an advertising business, might have a really high gross margin. Both are okay. You really have to understand the industry and what's comparable within that industry in order to understand if the company itself is performing well. So you can always perform benchmark analysis, not just to other companies, but to industry norms. So let's go into liquidity in detail. These two are the most important ratios for liquidity that you need to know. You have your current ratio, which is current assets divided by current liabilities, and your quick ratio, which is cash and AR and short-term investments divided by current liabilities. So what's the big difference here is your quick ratio essentially takes out your inventory from your current assets. Your current liabilities are liabilities that are less than 12 months in nature. You might have a current portion of notes payable related to your current liabilities. You also might have payroll liabilities, your accounts payable related to vendors that you have to pay for, etc. While your current assets are going to be your cash, your inventory, your AR, and your short-term investments. Quick ratio takes out the inventory to put even a bigger stress test on what if you're not able to sell that inventory at cost. And so these two ratios are just great at telling you, can you survive for the next 12 months? If you have more liabilities than your current assets, you're in trouble. So what's the story of liquidity? Can your company survive for the next 12 months? Remember, low ratio means you're not able to pay your suppliers or employees. You're going to have to find new debt or get cash quickly in order to survive. Higher ratio is good, but it also can mean you might be too conservative. Maybe you should invest that cash back into your company so that you can grow faster. So let's also talk about leverage and solvency. So leverage and solvency ratios include debt to equity, debt ratio, and interest coverage ratio. So now we're looking longer term. We're looking, can the company survive more than 12 months? So this includes the concept of debt to equity, where you take interest-bearing debt divided by equity. So the way you can think about this here is if a company has a lot of long-term debt and it's a huge component of their equity, or it's even greater than their equity, that could mean the company has an unhealthy amount of debt and is at risk of being insolvent. Same thing with debt ratio. If your total liabilities are a large portion of your total assets, you could be in quite a bit of trouble. Your interest coverage ratio is trying to tell you how much your interest expense is covered by your earnings before your taxes and interest expense. And so that's going to be a helpful ratio of, can your earnings actually cover your interest expense? So you can imagine that if you had more interest expense in your earnings, your company is going to be in a lot of trouble. If you have a credit card that has more interest expense than your current income, you're going to be in a lot of trouble. And so that's the same thing for a business. So the story of leverage is, can the company use this debt wisely for growth, or is it in over its head? A low debt profile may be too conservative, but it also might mean that they need to take on more debt to grow. But a low debt profile could also be beneficial from a risk perspective. You really don't have as much risk when you have a low debt profile. If you have a high ratio, you're more aggressive. The company may be at longer term risk of failing, but you also might have more growth associated with it. So again, you have to look at industry norms and that how effective the company's managing its cash flow related to its profitability and cash flow metrics as well. So let's apply all this. Let's meet Jimmy. So Jimmy has $5,000 in cash, short-term liabilities of $2,000 of credit card debt, and long-term liabilities of $10,000 student loans. Now remember, we're just going to look at Jimmy, so you can use this in a personal finance perspective, but from a business perspective. So you could assume this would be just like a business. Jimmy has pretty low assets. Like we could just do a quick assessment and say, hey, Jimmy doesn't look like he's in great shape, right? He has pretty low assets compared to his short-term liabilities to long-term liabilities. So let's just do a liquidity and solvency assessment on him. We can also do an equity calculation here and see that he has negative equity, right? He has negative $7,000 in equity, which is never a great sign. To be real, this is really the profile of a lot of college students, right? You've taken on student debt, you haven't made a ton of money generally, and therefore you have less equity. So what's his current ratio and debt to equity ratio? We can calculate this pretty easily. We just take the $5,000 of cash divided by his $2,000 of short-term debt, and we get a ratio over 1, right? His credit card. So he's 2.5. He's okay. He's going to make it through in the short term if he doesn't take on more short-term debt. His debt to equity ratio shows that he's not solvent though, right? Jimmy's in a little bit of trouble here. He has $12,000 in overall debt. That's his credit card debt and his student loans, and negative equity. Negative situation here is never good. And so it's showing you that he cannot survive in the long term based on how it is. So he's going to need to either figure out how to cut down his debt in the future, make some more money, and we'll look at his profitability in the future, or he's going to be in trouble in the long term. So Jimmy's okay for now, but he's in trouble in the long term. So let's talk about profitability then. So Jimmy better be profitable. This college degree better pay off, right? So how do we assess profitability? First, just gross margin, your gross margin percentage. You're going to take your gross profit, which is again your revenue minus your cost of sales or cost of services divided by your revenue. You also have your operating margin. Now you're taking your earnings before interest and taxes and dividing it by revenue. So again, this is just taking out your operating expenses like your salaries, your rent, your admin costs that were related to non-product costs like non-cost of sales. And then your net margin percentage is your net income. So you remove everything and figure out your revenue. So net income divided by revenue. I really think that's the gold standard. At the end of the day, indicators help you figure out how effective you're being with your cost profile of your products. The operating margin tells you how effective you're being with your non-cost of sales expenses. And then your net margin tells you the real story of like how you're doing overall at the end. And so you can use these to layer on to figure out where a company might be struggling, if they're struggling on their tax strategy, if they're struggling on their expense management or their cost of sales management. So let's talk about the story of profitability. For every dollar the company makes in sales, how much does it get to keep? That's really the story of profitability. So if the company is selling a product at $100 and keeping 50, is it keeping 50 or is it only keeping 2? And so the real takeaway here is either is okay, right? You could have a professional service company that keeps $90 for every 100 of revenue. And then you can have Walmart that's keeping $2 or $3 or $5 for every $100 of revenue. And both are okay, but generally for the lower margin, you need a much higher volume of sales. So that's where you can have your grocery stores, your commission-based models like Upwork or Uber, these types of models that just have huge volumes, but very low margins. So that's your quantity versus you can think of that as your quantity of services versus your quality of services or dollar expenses. And then for your higher margin businesses, they're generally harder to scale, but that's not always the case. Sometimes you have a golden cow that's like that. Google, Amazon, advertising models or software models where you can have high margin, high scalability, but those are much harder to pull off. You need a lot of IP and initial investment for those. So let's look at Jimmy again and figure out how his profitability is doing. And so let's say he makes $5,000 a month pre-tax and he pays $2,000 a month in taxes, $2.5K a month in rent, and $500 a month in just going out, like eating out and having a nice time or getting groceries. What's his gross margin and net margin percentages? Let's figure it out. How is Jimmy doing? So his gross profit, he's just making $2,000, right? Of gross profit. We take his $5,000 minus his rent and minus his going out. He has $2,000 left over. And you can see how this isn't that effective, right? His gross margin percentage is 40%. It looks really good, but it's not really considering taxes, which is a necessary part of doing business. So it's not my favorite. It's just helpful to figure out of what's in his control. And so he has 40% margin. Could he cut and make it higher under his controllable variable factors, like could he reduce his rent or going out costs or increase his revenue? His net margin, though, you see is 0%, right? The rest goes to taxes. So Jimmy needs to cut costs. He can't control the tax profile as much, especially if he's a W-2 employee. So he needs to figure out if he gets a roommate or he's going to be in trouble. He's not going to be able to make ends meet in the long term. So he better make sure that his investment in his college education is worthwhile. Whatever he's going to school for, better raise that salary above $5,000 a month, or he's going to be in trouble for the long term, and he better start managing his expenses now. So let's talk about efficiency now. So the cash conversion cycle, you can really think about it in this way. You have DSI, DSO, and DPO. These acronyms are really your days outstanding for your accounts, for your inventory, for your sales, and for your payments out. And so the way to think about this is, how many days does it take to turn inventory into cash? And so again, you don't have to memorize all of these in practice, but you're going to have to memorize these for CPA, CFA, et cetera. And this is a really exciting cycle because you can see how quickly, essentially, you buy a piece of inventory, and then how quickly can you convert that to a sale, and then collect on the sale, and then pay for that piece of inventory. And then the payment out of the inventory is actually negatively correlated to this cycle because you actually wanted to delay payments when possible to maximize your cash flow. Amazon's a master of this. Nike is great at this as well. They really have figured out how to optimize their growth by quickening the payments in, quickening cash flow in, and deferring payments out. You can also even quicken the cycle further if you do things like factoring, which we can cover later. Let's go over the formulas. You need to know your AR turnover. So remember your turnover ratios, which you should learn in previous classes, are sales divided by your average AR for AR turnover. Same thing you can imagine for every other major turnover ratio. For example, inventory turnover ratio. Your cost of goods sold is your major driver for inventory, and you take that over your average inventory. Remember, your averages, you just take your ending balance, your beginning balance, you add them together, divide by 2. And then for AP, it's your cost of goods sold divided by your average AP. So you take those average ratios, and then you're just going to convert them into days. So you take 365 divided by those turnover ratios. For market and valuation snapshots, now this is where it gets exciting. So now we can take all the information we've learned. We've identified 2 quality companies based off the ratios we just identified. We can then determine if they're comparable. And then if they are comparable, then are they a good value? Like compared to each other, is one company a better deal to purchase now than the other? And so that's our market and valuation snapshots. So we have EPS, earnings per share. That's our net income divided by number of shares. We have our price earnings ratio. That's price divided by EPS. We have our dividend yield. That's dividends per share divided by price. And the advanced valuation topic, the PEG ratio. And so PEG is our price and earnings ratio by a growth rate, and that's the annual EPS growth rates. So we're going to be trying to figure out here, like to break down these ratios, we are going to be looking at essentially, are we getting a good deal? So if we're looking at 2 companies, we can see if a company is growing faster than the price has justified for it. So keeping your PEG under 1. Or if you're comparing just price earnings ratios, which company has a better price earnings ratio or price earnings growth ratio? So you can compare companies, and if you think they're comparable, you can choose one and to determine if it's undervalued compared to the general industry or market, or if one's overvalued and maybe you should sell it. Let's say Jimmy doesn't take our advice. We told him that he needs to cut his costs, but instead he wants to take his money and invest it. So he better invest it wisely, at least. Should he buy Google or Microsoft? So Google, at the time of me recording this, had a 203 market, at 203 per share price, a $9.25 EPS, and an 80-cent dividend. Microsoft had a $520 share price, a $13.62 EPS, earnings per share, and $3 dividend. And so the question is, if he thinks both companies have the same outlook, and let's say we did the ratio analysis and then both came out the same, which is a better deal? Google, we can figure out, it has a price earnings of 22. We just took the price divided by the earnings, and has a 0.4% dividend yield. Microsoft has a price earnings ratio of $38 and a 0.6% dividend yield. All else equal, we can assume that Google is a better price. So either Microsoft is overvalued and we'll go down to the value of Google. The 0.2% incremental dividend yield really doesn't play well here. It doesn't drive a huge difference in value factor, right? If we saw a 3 or 4% dividend yield, maybe that'd explain the higher price ratio. And then or Google is going to increase in price. And so that's why you might look in the news now and there's a lot of analysts saying Google will go up in price or Microsoft will go down in price. It's because of these analyses and also the PEG, which we can calculate at a future time. Hopefully this is a good summary for you all in order to figure out how you can apply financial analysis practically. Practice these ratios, but try to memorize them if you're taking them for tests. These should be all the major ratios you have to learn, and then just practice applying them. The biggest and most important thing is making sure you're able to identify how to apply these ratios and calculate them independently. Hope you enjoyed the lecture. Hope you found it valuable, and have a great day.